Good morning and welcome. Thanks for joining us. We appreciate you making the time. I'm Dennis Morton, and along with my partner, Cody Brown, we're co-founders of Morton Brown Family Wealth. We're an advisory firm designed to help investors live purposeful lives through the stewardship of wealth. So we see we have many friends joining us this morning and with some new acquaintances as well. So by way of introduction, Morton Brown is a fiduciary advisory firm, and the family wealth in our name is intentional. So our job is to help people make the unique financial decisions that have a positive impact on their lives. So Katie and I are both certified financial planners. So we have expertise in investing, retirement, taxes, estate, and insurance. So when we touch on these topics today, it's all in the context of improving your quality of life. So let's start there. You've all joined us for a reason today, and that could be external, driven by what's happening in the stock market or in your employment situation. Or the reason could be more internal, wondering if you're on track or if there's something that you should be doing differently. So we want to start by framing today's situation as something a little lighter than the pandemic that we're all experiencing. I'd like you to think instead about what you're trying to accomplish financially as a game, but not the kind of game that you might think of. Games like football, tennis, golf, they're all finite. They have rules, they have structure, winners, losers, beginnings, and ends. The author Simon Sinek, in his book, The Infinite Game, describes a more worthy game, one that might resonate with the challenges and opportunities that you see right now. An infinite game doesn't have a finish line, and there's no time when we kind of clap our hands and say, now we're done, because we never really do that, do we? Even when we retire, we might say goodbye to coworkers and a career, but we don't stop. We move on to something compelling and long-term. In an infinite game, there's no such thing as winning. We just hope to keep playing and perpetuate the game. So if you think of your financial future as a finite game, you're going to focus on making more money, beating or timing the stock market, using the stock market as a scoreboard to find out how you're doing, and comparing yourself to other people via relative success. And what do you notice about that list? Most, if not all of it, is out of our control, especially the part where we measure ourselves against other people. So what does the infinite game offer? It offers us a just cause, something worth pursuing because it's uniquely ours. A just cause gives us a specific vision for the future, a challenge and an opportunity for what hasn't been built yet, and the freedom to create a future the way we want it to look and feel.
Yeah. Dennis, I love how you kind of break that up into two games, because it is interesting. There are two, and you have a choice. So if you want your financial future to be a finite game, you'll chase the latest fad in investing, or you'll watch CNBC and allow your emotions to follow the roller coaster of the markets. Or perhaps you'll compare your performance to a benchmark that may or may not be relevant to your success. So what's wrong with playing the finite financial game? It doesn't once consider what's meaningful to you, your quality of life. It's focused on return on investment, not return on life. What your money's doing, not how it's working for you. Whereas the infinite financial game is more focused on our why. Why have you worked so hard? Why have you saved this hard? It's an optimistic view of what the future can be, and it helps to build the skills to succeed in any environment. So we want you to carry this idea of investing and planning as an infinite game in your mind as we talk about what happened recently in the markets, what could happen in politics, taxes, or COVID. We believe your success will come from embracing the infinite over the finite. And by the end of today's session, we want you to feel like you've gained awareness about the present, some insight about planning for the future, and a roadmap for how to navigate the uncertainty to come. So we're going to begin with an update from Cody Demmel. Cody joined us earlier this year with 6 years of experience. Having completed the coursework already for the Certified Financial Planner designation, he'll be sitting for the final exam later on this fall. And Cody's going to discuss how the markets have been behaving during one of the most unique years of our lifetime. And then we'll offer some insight into how we can anticipate election season, potential policy changes. I'm going to then talk a bit through the landscape and how that continues to change for retirees when it comes to income, estate, tax planning. And then finally, Dennis is going to introduce our return on life process that helps to align your investing and planning with your just cause, your infinite game. So this is meant to be interactive. I encourage all of you to use the comment section that you see there in the bottom corner of your screen. If you have questions, comments, or you need clarification, if there's something that's timely that we're talking about, we'll try to answer that right away. Otherwise, we'll probably hold the questions until the end. So let's get started. Cody, I'm going to let you lead us with some insights on what's been driving the markets so far in 2020.
Thanks, Katie. Good morning, everyone. My name is Cody Demmel, and I'm a financial advisor here at Morton Brown Family Wealth. So before I start on the market update section and what we're looking at, we wanted to ask you a question to see how confident you are in your investment strategy currently and going forward in this volatile year. So if we can, there we go. Thank you, Maddie. So if you can just choose the best response for how you're feeling currently about your investment strategy, that would be great. We also just wanted to let you know that this is private, so your responses won't be, no one will see exactly what you choose. We'll just show you what the overall feeling is.
It is interesting. I think this year has been, I think if we had asked this question in March versus the summer versus now, it's always fascinating how that can change over time and just how impacted it can be from current events. So I'm really curious to see how this comes back.
Yeah, and I think it can feel right and wrong, and depending on the day and depending on what the news flow is. I mean, there's certain people who are feeling really good about being, heavy on cash back in March, and maybe that creeping suspicion of, oh my gosh, did I miss something on the way back? We've seen market pullbacks before, just not that fast, and the bounce back has been just as dramatic.
Yep. So a couple more responses, and then I'll go ahead and share the results. So if we just want to give it a couple more minutes, a couple more seconds. Okay, perfect. Around 80% of people voted, so we'll go ahead and publish this. So can you guys see the results now, Katie and Dennis?
Yes. Mm-hmm.
Okay. Perfect. So around actually 91% of people voted, with the majority feeling confident. So that's good to see.
4% indifferent and about 13% concerned.
Yep.
That's good. The one investment strategy, that's the wild card in there, because we do see that from time to time.
Yeah.
Great. Awesome.
So let's get on to the market update section. So first, we just wanted to go over a year-to-date overview of what's gone on in the market in this volatile year. So we can see year-to-date by this orange line is the S&P 500. So that's the 500 largest companies in the United States. It's up around almost 8% year-to-date, which is great to see, considering we were down over 30% in March. So we've had quite the recovery. But one thing that we wanted to point out is you can see this purple line is the NASDAQ. So that obviously has had the best return year to date, up almost 31%. And that's drugged the entire market positive. If you look at this green line, the -4%, that is the S&P 500 equal weight. So that index is all 500 companies have an equal weight inside the index, and you can see that that's actually -4% year to date. So the average U.S. stock is actually struggling.
Wow, that's a high concentration.
Yeah, those strong winners are really the ones that have boosted up primarily technology stocks there, and that 30% return.
Yep.
Yeah, and I think a lot of what maybe the sense that we get for people being confident in their investment strategy now is not that things are great, but they've definitely gotten better. And that feeling of getting better, I think, masks over a lot of things. Interesting thing, Cody, that you talked about the volatility earlier this year. I think a lot of us are anchored on what February and March felt like, and just those steep drops and then the bounce backs. But things really haven't been that volatile recently. For all of this turmoil, I think it feels like, if you turn on the evening news, it feels like there's such a churn to things. But it's been a pretty steady climb here over the last couple of months. Look at that S&P 500 level change over the last couple of months. It's like almost a straight line up.
Yeah, from June. I mean, we had a little dip at the end of June. That was just from the unemployment numbers. But yeah, we've had a steady rise up, which is good to see. We don't have the up and down volatile that we had in February and March.
Right.
And then speaking of the recoveries, I mean, the recovery that we've had from the March 23rd lows, I mean, the NASDAQ is up almost 71% from the lows. The other indexes, so the S&P 500, the Dow Jones, and the Russell, which is the small cap index, are all up over 50% from the March 23rd lows.
Right. You had little changes of leadership in there. There were little blips where, some of the value stocks took over leadership. Yeah, happening right back there. But really, ever since late June, it's been one story.
Yeah.
And we were kind of looking for small caps usually lead us out of recoveries. There tends to be that bounce snapback. Just hasn't happened so far this year.
Yep.
And it's interesting. It's not that they haven't done their job. I mean, they're still up over 50%, and they've had great, strong returns. It's just it's been overshadowed, and I think some of that's the uniqueness of the environment right now.
Yeah. So then this next chart, I think, does a great job of going over some of the key events and what the stock market did from those. So the first was when the World Health Organization declared coronavirus was going to be an outbreak. We in the US weren't exactly sure how that was going to go. So obviously the market went up a little bit since then, since the World Health Organization announced that. We hit record highs on February 19th, and then the drop that we had in just a little over a month, we were down 34%, which is crazy to think about. 34% in a little over a month. And then the second event is when the Federal Reserve stepped in and said that they'll do whatever it can to help the economy and make sure that they're providing the liquidity that the companies need to not default. And then the third, so this is when the first big unemployment numbers started coming in. And I mean, we hit 15% unemployment. So the market obviously did not like that shock of news. So that's where we saw the decline in the S&P. But then, like Dennis said, I mean, ever since then, we've been pretty much straight up. I mean, we had the big blip on the fourth event, but then again, we've just rallied higher again.
This chart reminds me, there's two words that come to mind when I see this. It's speed and depth. I mean, things happen so fast and so far down. But the question I think that's on our minds now is more duration. How long does this last? And this is the market side. We've all talked about the separation between what the market's doing and what the real economy is doing. And the longer the real economy stays with these, unemployment in double digits and just, Fed support of the financial system and all of these distortions that have happened, the longer that lasts, we start to see the ripple effects, I think. And that's why we still think that being diversified matters here, because we're in unprecedented territory when we get speed and depth followed by duration.
Exactly. And then obviously we have another very important event coming up later this year, which is the election. So when I was doing some research on how the market performed before and after the election, one chart that I thought was pretty interesting is this chart on the left, which goes over all the presidents over the past almost a little over 90 years. You can see that the blue is obviously the Democrats, the red is the Republicans. It's almost up in every single portion, obviously, besides Bush when we had that big pullback at the very end of his term. But I think that's just important to think about, that it's not exactly what party is in office, but it's more about what the market cycle and the economic cycle is doing during their time.
Mm-hmm. Mm-hmm. Yeah, we've been comparing this election cycle. There's a lot of similarities to 2008, the 2008 election cycle, because I think whoever is inaugurated in January of 2021, no matter what their policy platform says here heading into the election, their agenda is going to be on the back burner compared to dealing with this crisis. And I think back to January of 2009, during President Obama's first term, the financial crisis was the order of the day. That's where the focus had to be. And then everything else came. So universal health care was kind of punted a little down the line until the unemployment situation improved and a lot of other, the washout from the financial crisis. So I think next year we're still going to be dealing with pandemic fallout and a lot of the unemployment issues. So, either party is going to be hard pressed to navigate around that and gather a lot of political will for some of the sweeping systemic changes that they might want to make.
Also, thanks for some of the chat discussion. We'll answer those at the end if we can. Dennis, did you want to say something there?
Yeah, one of the things, just when we talked about volatility, I've heard in conversations with clients, we hear often, do we think there could be a correction? Could there be a pullback around the election? Historically, there has been more volatility there. But looking back at how smooth things have been for the last couple of months, a 5 to 10% pullback would be totally normal right now. I mean, in fact, those things are supposed to happen a couple of times a year historically. We had, of course, the huge pullback in February and March, but seeing 5 to 10% kind of to wring out a little bit of risk would actually be a healthy development. So be careful not to to read into too far some of the volatility that might come in October, because it may just be a natural reassessment of the marketplace as things, progress toward a change in administration or a change in the economy.
Yep, exactly. And then before we get into a potential pullback and where we are in valuations, I just wanted to point out this chart on the right that I thought was very interesting. And obviously, this doesn't mean this is what's going to happen this year, because as we all know, this year is just very unique in its own aspect. So, but in history over the past 80 years, if the stock market is up the 3 months prior to the election, so from the beginning of August till the beginning of November, the sitting party has won every single time. If the stock market is down the 3 months prior, the new party, which would be the Democrats, have won every single time. Again, this isn't saying this is going to happen this year. It's just very interesting to point out.
Right.
And then speaking of valuations, so this chart on the left goes over the S&P 500 as a whole, their price per earnings. So how much you're paying for each earning that the company is making. So we're at almost all-time high. Well, we are at all-time highs as the S&P as a whole. As you can see, we had this big spike up because, the stock market's rallied, even though the expectations for next year are a little muted based on obviously everything that's going on. So we are at all-time high valuations, but again, this is just expectations moving forward. So this could be a little wrong. It's just what the analysts think, but I think it's important to point out, like Dennis said, it wouldn't be like crazy or unnormal to see a 5 to 10% pullback. And then I just think this chart on the right, and what we showed on the first slide. So this is year to date by the value growth, and then if you're a large cap company, so a very large company, mid-sized company, or small cap company, the only positive average is large growth, and it's up around 10% year to date. You can see every other style is struggling, especially the value stocks this year, which I think could, we could have some outperformance there moving forward if we do have a change in the cycle. Do you have any thoughts on that, Dennis?
No, I think this is where there are a lot of famous investors right now who are waiting for that to happen. Name a famous investor for the most part, whether it's a famous hedge fund manager or Warren Buffett or anyone else. They sit on the value side of the equation for the most part. They're looking for inexpensive companies that they can buy cheap and ride back up. That's not what's happening now. That growth side is expensive and it can get more expensive. But there's a lot of value-based investors who are waiting for that rebalancing to occur, and they've been waiting for a long time now.
Yep, exactly. And one of the reasons why we think valuations could be at all-time high is the TINA trade, which I know Dennis has discussed before, which is there is no alternative. So speaking of that, like we said, you still need to be diversified, but this is just one of the reasons why the stock market could be at valuations of all-time high. So this chart on the left is the 10-year treasury in the purple, and then the real interest rate. So inflation minus the treasury is actually negative almost 1%. So you're not keeping up with inflation at all with the 10-year treasury. And then this chart on the right is the corporate bond yield. So what U.S. companies, their bonds are yielding. I mean, you can just see we're at all-time lows, 50-year lows. I mean, we hit this back in the 1960s, but it's just crazy to think that if you're not able to get a yield on some of these bonds, especially these junk bonds, which is the orange line, you're almost taking on as much risk in these junk bonds as in the stock market. So that's why people are arguing that they're not going into these bonds, they're going into the stock market, and that's one of the reasons we could be at all-time high valuations.
Mm-hmm.
And that is one of the things too that is one of the things too that we're always on the lookout for. How much has your risk creeped up? Because if you're not getting the yields where you would typically get it in the more stable asset classes, now you're reaching for yields perhaps in either the lower quality bonds or the stock market. And it's it's really important to make sure that you understand the risk that's in there in case we do have pullbacks.
And I think this also, that upper left chart highlights a risk that we think about. What are we immune to right now? Immunity is a great word to throw out right now, but what risks are we kind of not aware of? Everyone knows that the stock market can drop by a lot. That just happened, and it's happened a lot here in the last 20 years. There's been quite a few kind of bear markets and crashes, but we haven't had inflation for some time. When you see those negative real yields, when you see inflation, which means inflation expectations are higher for the future, it just creates this conundrum of, if I'm going to get out of the stock market, if I'm going to go into cash, I'm losing ground.
Yes.
If inflation creeps up, I'm losing because I'm not getting paid. I'm getting paid zero for my cash. For 10-year treasury, I'm going to get paid 0.5% or something like that. So what is the alternative? If I'm going to get out of stocks, what do I go into, and how do I compete against inflation? And one solution to that is, first of all, staying in. So it sounds like for people who are feeling confident about their investment strategy, odds are you probably weathered the course through this year, stayed in, and participated in that 50% rebound that we've had. That's one way to keep up. But we just have to be mindful that there are different types of risk, and inflation hasn't been one for a good 20, 30, 40 years, but it's something out there and a specific threat for retirees. So it's hard to be a conservative investor, especially now, but it takes a nuanced approach to say, how do we still keep up?
Yeah, exactly. I mean, it's still obviously very important to be diversified throughout your portfolio, because if we do have obviously one of those big pullbacks, I mean, good thing we've had the recovery, but we still want to be diversified, especially if you're getting closer or in retirement. I mean, you can't hold which I think is important to show in this chart. If you have a big decline like we had in 2007 to 2009, the stock market took over 3 years to get back to even. So if you're in retirement, you're taking money out, and it takes over 3 years just to get back to even. If you're in all equities, if we do have another big pullback, I mean, that would be really bad for your overall investment portfolio. And this is why we want to be diversified. And I think this does a great job of showing. So the 40-60 portfolio, which is 40% in bonds, 60% in stocks, took the same year it got back to even, which is great. And then the 60-40, so obviously a little more risk. So 60% in stocks, 40% in bonds, took a little over a year to get back to positive.
And there's a couple of questions. We can get into more specifics at the tail end of the presentation, but the question about cash comes up a lot. And should I be going to cash? And is that a good way to manage risk? If you look at the bottom, this 20-year annualized return. So this is taking us back. Now this is through the end of 2019, so it doesn't factor in this year. Although considering we're back to the high water mark, it's pretty good comparison. But this covers the tech bubble bursting, the real estate burst, everything in between. Look at the asset class returns. Real estate comes in as the number one, even despite all that happened in the 2000s. Real estate's the best performer. Then you see the S&P 500 averaging 6% a year. You have gold averaging 8% a year. Look at where the average investor lies. 2.5% through all of that, through just that long time period of expansion, all the way up to it was Dow 30,000. The reason why the average investor ends up in that place, and there's a lot of research that's gone into behavioral research that's gone into this, is because they go to cash and miss out. And Fisher Investments did a study earlier this year where they've called this term break-evenitis, which is a lot of investors they'll stick with the dip, they'll hang on, they'll make their way through, but they wait to get back to their high watermark. In their mind, they're anchored on where I was at the beginning of the year or my highest account level, and they get there, and then they start thinking about getting out, saying, okay, now it's time to leave. According to Fisher, the average time, once the market gets back to its break-even point, on average, it's almost another 4 years of expansion beyond that, totaling on average about 40%. So that's where we talk about we just have to be careful about how we navigate the idea of cash versus being invested. One solution to that is thinking more about active management. So, if you're a passive investor, you're riding the market, all its ups and downs in an index fund. Active managers can have the flexibility to either raise cash, move between different asset classes. So that's one of the nuanced ways to say, okay, if I don't want to go to, move out of the market, can I add a layer of intelligence here instead of just being indexed to the world? That's an idea and something that we always incorporate into our portfolio strategy.
Yeah.
Yep.
I think the other side of that too is we often talk about if you make the decision to go to cash, there's another decision to go back in. And that one is most often much harder to make. And unfortunately, we have had clients come to us that have said, I was nervous and I went to cash and I just didn't know when to go back in, and I've been in cash now for multiple years. And it's really challenging, I think, to make that call in both directions.
Yep, exactly. So go ahead.
No, go ahead. Yep.
I was just going to say, so I think that's it on the market update side of things. So I would like to pass it over to Katie to go over the next sections and what we are thinking going forward of how some changes could occur, whether it's the election or just moving forward.
Sure. Thank you, Cody. Really appreciate you helping to walk us through the state of affairs of investing. So I do want to start rounding out the conversation a bit further by looking at this environment through the lens of financial planning. So we've had a lot of changes up to this point, and there may be more coming. I'm going to start with what has changed and why you may want to rethink your retirement income plan. And then I'll touch on what could change and things you could do to make the most of present opportunities. So as a refresher, last November, the Secure Act was passed. And earlier this year, the CARES Act was passed. Without rehashing all the details, I just want to remind you of a couple of things. So the required minimum distribution age in the Secure Act was pushed back to age 72 from 70 and a half. That's the age in which you are required to start taking distributions out of your retirement accounts. The CARES Act, passed earlier this year, suspended all of that for 2020. That's not to say that you can't take distributions, but if you weren't aware and you normally take distributions, you don't have to this year. So you can really make that decision for yourself as far as what you need for your personal income needs. The other thing, though, number two, that I want to point out from the Secure Act last year, and this is really a biggie, it has to do with inherited IRAs. So an inherited IRA, if it's received by a non-spouse, so your children, for instance, now going forward after 2020, if a non-spouse receives that money, they have to fully distribute that account within 10 years. It used to be that and some of you may have inherited IRAs. We have a number of clients that have inherited IRAs that were received prior to 2020, and they take out distributions throughout their lifetime. You may have heard of the term, the stretch IRA. Well, that is no longer. So for instance, if you have say $1 million retirement account that flows to your successful adult children, they may be forced to fully distribute that account within 10 years while they are in their peak earning years, thus compounding the taxes and really minimizing their inheritance. So all of this might have you rethinking your income strategy. If it's your goal to leave an efficient legacy to the next generation, you may want to start spending down those retirement accounts to meet your income needs while you are potentially in a lower income tax bracket, and then save your non-retirement account money for the next generation. Or Perhaps even take it a step further and process Roth conversions to shift some money from that tax deferred bucket to a tax-free bucket, which really is the ultimate asset to inherit. I know for a number of people, there is this sweet spot between when they retire and when they start collecting Social Security or start taking those required minimum distributions, where they are potentially in the lowest income tax bracket of their lives, in which case that's a great time to put to work a Roth conversion strategy. Once again, if that's your goal, recognizing that you now are bearing some of those taxes, but potentially at a lower tax bracket so that your heirs can receive a more efficient inheritance. And just to touch on Roth conversions for a minute, I really want to point this out. So a Roth conversion is when you take a taxable distribution from your retirement account, and then you put that money, say a traditional IRA, and then you put that money into a Roth IRA, essentially moving it from tax deferred to tax free. But I want to point that out because, once again, emphasize it is a taxable event. So if you're interested in doing something like that, please make sure to involve your professional team in figuring out what that looks like. So just a minute ago, I mentioned Social Security benefits. Social Security benefits. This is one of the most love-hated things I think out there. People love to try to figure out, what is the best. It's almost like a game to be conquered. And unfortunately, I think a lot of people collect their coins too soon. Most people. So you are probably aware that if you delay benefits, you delay when you receive that money, that your income increases. Likewise, on the other side, if you take Social Security early, you're actually being penalized for taking it early. There is a 50%, more than 50% increase if you delay benefits to age 70 versus 62. Yet only 4% of Americans actually wait until age 70 to start collecting Social Security, according to the Social Security Administration. So, and I recognize some people don't have the choice. Some people need that income early, or there's another compelling reason to take it soon. But I want to highlight 4 reasons for delaying Social Security. So once again, if you delay benefits from your full retirement age, say 67 to 70, you get a guaranteed 8% increase in that benefit amount. As Cody just talked about, interest rates are near zero, and you cannot get a guaranteed investment rate better than that right now, or at least it would be very difficult to find one. So it's a great investment. Cost of living adjustments. Number 2, most traditional pensions do not have cost of living adjustments. It's very rare that we see those. Social Security does. And if you delay, and now your income increases when you start your benefits, that's where your cost of living adjustments start from. So now you have a much higher base, and those increases compound over time. So just capturing those cost of living adjustments is huge. And then number 3, if you're married, to provide for your spouse. So if your benefit is greater than your spouse's benefit and you predecease your spouse, he or she will receive survivor benefits, which will increase their income to the level that you were at. And so it helps to make sure that they are better positioned potentially later on in retirement if you're no longer around. And I'd love to share a little chart here. Oftentimes when we talk about Social Security benefits, we talk about the crossover age of when it makes sense to delay. And what I mean by that is if you delay benefits, how long do you have to live where it actually generates more money on the other side? So what age do you need to live past? And in most cases, that crossover age is somewhere around age 80. The thing that I love about this chart is that it shows a crossover age under a number of different scenarios. Once again, right around between age 80 and 82. But we have our little couples listed here. And it's a great reminder because even if you're saying, my health isn't as great as I would like it to be, or my family history tells me that longevity just might not be in the cards for me, this still reminds us there's a 75% chance that between your spouses, one of you will live beyond age 87. And that's far beyond the crossover ages. So don't underestimate the potential benefit for your spouse if you are married. And then finally, less pressure on the portfolio. So if you can create a larger income stream or diversified income streams, things outside of your investment portfolio, then that takes some pressure off of the investment portfolio, and you can potentially take less risk and be less impacted by any market volatility. So I just wanted to highlight those reasons. Once again, delaying is not a fit for everyone, but I would love to start changing the mindset and start with the assumption of I'm going to collect benefits at age 70 unless there's a compelling reason to start early. I think oftentimes people approach it from I'm eligible at 62, so I'll start then unless there's a compelling reason to delay. I'd love to flip that around.
Katie, if you could weigh in on one thing here real quick on the Social Security side. It's less pressure on the portfolio, but it also helps us to think a little bit differently about how your IRAs are invested, how your taxable accounts are invested. I mean, there's really a compelling case as we head into the end of the year. Does it make sense for your IRA to be invested more for the short term, your Social Security to plug this particular gap, and then different assets take on a long-term approach? I think those bucketed strategies, it's all kind of a part of the same conversation.
Yes, thank you for bringing that up, because you're exactly right. And if you're delaying benefits, then you have to figure out that income strategy early on to help fill that bucket. And so you're right. There may be a bucket that's shorter term money, whereas the other, you can be more aggressive with it and not kind of like Cody showed on that recovery chart. It's okay to put more stocks in there because the recovery, you don't need that money necessarily immediately. You can be more patient with it.
Yes.
So I love that. All right, let's switch gears for a minute and talk about some changes that may be coming down the pipeline and what you can do now to prepare or even take advantage of the landscape. And to kick that off, I'd like to start with a small poll. So we'll get this pulled up for you. Just a minute. I'd love to get everybody's thoughts on. I'm going to start talking about taxes, and I'd like to get everybody's thoughts on where they think or where they are most concerned about changes within kind of the tax or policy structure. And we'll see if it's being a little buggy for us. Okay, well that's all right. Well, if it pops up, we'll break for a minute. But otherwise, let's chat a little bit about what we could expect on, from policy changes and that may potentially impact taxes. So we all should expect that tax law changes are going to happen, whether through accelerated policy changes or simply sunsetting of existing laws. From an income tax perspective, as it stands right now, income tax brackets are due to sunset in 2026. Increasing the top bracket to 39.6%. It's fair to acknowledge that there are proposals out there to accelerate that. There are also proposals to increase Social Security taxes for top earners or to reduce the standard itemized deductions, increase capital gains taxes, not to mention changing corporate structures. So if this is of concern to you, the first thing that I would suggest is ask yourself, how exposed am I to those increases? If you are retired, you may not be in those top income tax brackets. So you might not be subject to some of those. However, you might be more concerned about capital gains taxes, for instance, in which case, if you know that you're going to have to make some sales over the next couple of years to free up some income for yourself, you may want to take some of those gains this year while we know that capital gains rates are very low. If you have charitable commitments, for instance, you're concerned about itemized deductions, you may want to consider pushing off some of those charitable commitments until January of next year. And also, don't forget about tax-efficient ways of giving, though. If you wanted to process some gifts this year or even next year or going forward, I love something that we do for a lot of our clients, and I just love this, is we take advantage of the qualified charitable distributions, QCDs. And what that is if you are 70 and a half or older and you process a gift, a distribution from your IRA directly to the charity, then that money never comes to you as taxable income. Normally that would come to you as taxable income. In this case, it doesn't even show up on your tax return. So you get the full benefit of that gift. You don't have to worry about itemizing deductions for it. It's just a really great way to gift and also potentially spend down your IRA once again, if you want to try to maximize the types of assets that flow to the next generation. So I love that. Something else to consider is, oh, and you know what? Here we go. We have, if you guys want to take a minute, I'd love to kind of hear your responses on what you are concerned about. I'm chatting about all of these a little bit, but I would be really curious to see what's top of mind for everybody. So please feel free to answer this question here as far as which potential tax changes have you most concerned? And I'll give them a minute just for everybody to kind of get their answers in. Yeah. And actually, while we're waiting for that, I love that people are putting some questions in the chat box. One of the questions out there was, if my spouse inherits or I inherited a stretch IRA, if my spouse inherits that, will they be required to take distributions over 10 years? Yes, I believe the answer to that would be yes. I would love to double check that, but since it's not coming from a traditional IRA, because typically if your spouse inherits an IRA, that's moved over really to just a traditional IRA. But if it's already started as an inherited IRA and it's received as an inherited IRA, and it's rooted from a non-spouse, my assumption, you're already taking distributions. My assumption is that they would be subject to that 10-year distribution schedule. But that's something I'm going to dig into and just confirm back.
I think a spouse falls into this eligible beneficiary category, which if I remember correctly, I think if you're a spouse, the rules previous to the Secure Act apply. So we'll double check on that, but I'm pretty sure you're right that it's the same. It's the previous rules. It doesn't jump to the new set because they're in that category of eligible beneficiary.
Right, but let's circle back on that.
Sure.
Oh, and actually the survey results are in. So it looks like capital gains taxes, increases in capital gains tax. About half of you are primarily concerned about that. Income tax increases, estate exemptions kind of come, just behind, and then standard deduction changes. So, and I think I would not be surprised if we saw some changes to all of those. And a lot of the reason is because we are so low on some of those rates compared to even, history. Yeah. So let's circle back and talk a little bit about estate taxes. So we touched on capital gains. I would not be surprised if that goes up. So maybe there is an opportunity to take some gains this year if that's of concern. From an income tax standpoint, if you have any control over the receipt of money, if you are a small business owner or whatever the case may be, if you have the ability to take some distributions maybe before year end that you would have normally pushed into, like if you do year end distributions, but you actually pay them out next year, you may want to front load those into this year. Or if you have control over the bonuses, the receipt of that income, you may want to bring that into this year if you have that ability to do so. So let's switch gears and then let's talk about estate taxes. So the federal estate tax exemption right now is at $11.58 million per person, or over $23 million per couple. It is the highest that it has ever been by a long shot, except for 2010 when it was repealed for the 1 year. So check out, I have another fun graphic I'd love to share. This just shows us the quick increase in that exemption amount. I mean, it wasn't that long ago, just in 2000, that the exemption was $675,000 per person. Now it's over 11.5 million. So it has gone up significantly. At the same time, this blue line here, that's the estate tax top tax rate. So for money that is subject to estate taxes, it's at 40% right now, which is definitely not the highest that it's ever been. So what does that mean? That means that the gifting environment has never been stronger. So if you are at all concerned about future estate tax liabilities, now is your opportunity to do something about it. This is a great time to look across your balance sheet and determine what the best asset is to gift. It may be appreciated stock, although word of caution, cost basis transfers with gifts, so plan accordingly. Or it might be a piece of property or maybe a business interest. There are a number of different strategies to efficiently gift property where you determine the timeline and control your tax exposure. And here's another tip too. You may be able to discount the property that's transferred to the receiving party. If that receiving party has any type of limitations on their access or control, then you might be able to apply a discount to it. So a closely held business, for instance, or a piece of real estate, those are great examples. And I've seen really great strategies put into place that discount those assets, and they're able to shift, from one generation to another or wherever you're trying to shift it to at a very efficient and cost-effective way. And something else to consider is non-gift strategies at this time. So where you shift assets without using part of your gift exemption or paying gift taxes. And the reason that now might make sense for that is because the Section 20 or the Section 7520 rate, that's the federally set discount rate, is the lowest that it's ever been at 0.4%. I feel like we're talking about all these extremes today, but it is true. So for annuity-based strategies where you want the payments to actually be low, so there's a larger piece of property at the end of the term for an heir, a low 75/20 rate is ideal. A couple of examples are utilizing grantor-retained annuity trusts or charitable lead annuity trusts. I've seen those executed very, very well. We've had some clients that we've helped with those. In both cases, your intended heirs will really benefit from any growth beyond that 0.4%. And the mechanics of those strategies are too nuanced for today, but I just want to introduce the concept and get your mind kind of thinking about what is the best way for you to shift some money or assets to the next generation, or at least open up that conversation. So, and once again, the whole goal of this is to encourage you to think through your personal situation and ask yourself, how can I make the most of the next 4 months to improve my quality of life while markets are high, taxes are low, and interest rates are low?
Yeah, Kate, you bring up a great point here, and especially as people are going to start to think about gifting strategies or potentially trust strategies, there's a balancing act, because in order to gain the tax advantages, you're giving up something. And a lot of times that's access, control, liquidity, all of those things. And I think it's important to maintain that balance between a flexible financial plan and then the tax efficiency, because we just want to make sure we're not giving up those things that we might need. You talk about people are living longer than expected. Do we have the right level of assets that are accessible to you? And then also what's going to be transferred to the next generation?
Yes, thank you for bringing that up. And there's always, we often talk about what makes sense on paper and what makes sense in reality. So there has to be a comfort level with what you're doing. And a lot of that does come back to the control and your comfort with, the level of control that's there, right, for either you or for, your heirs or intended recipients.
Right. Great.
So Dennis, I'd love for you to talk to us a little bit about return on life.
Yes, thanks, Katie. So for those I've had conversations with in the past, we've talked a lot about this in the meetings that we hold internally with our clients and our team members. But just by way of introduction, Katie and I have been observers of the financial industry for almost 20 years now. We've been in different facets of it. I started in the Wall Street world before going into the independent space. And the focus so often is on a lot of the wrong things. We talk about that finite game and how we can focus on the infinite over the finite, because in reality, I've seen people try and play the game of outperformance or try and stock pick their way to success, and rarely have I seen that be meaningful for them. So if there's a common refrain that we've heard at this as the crisis matures and we adjust to our new way of life, it's how can we sustain or improve our quality of life? And maybe you've been contemplating your quality of life. I mean, here's some examples of different ways that you might have been considering the timing of your retirement, where you live, your career choices, how close you live to family and friends, your hobbies, your health. So I want to start with a quick poll question. If we can pull up this particular question. In what areas of your life have you seen your quality of life improve during the pandemic? I'll give you a couple seconds to respond here. For me personally, it's something I always think of the different facets of life. There's family, there's work, there's spiritual, there's health, there's recreation, and I'm naturally a guy that the recreation part is always something I need to work on. Like I don't carve out that intentional space. I started to do that a little bit more during the pandemic, just because you really had to focus on what am I doing to kind of give myself a break a little bit and to recharge the batteries. So be curious as to where everyone feels where they might have improved during the quarantine. All right, so we'll wait for the responses to come up. And we talk a little about investing and planning, and Cody and Katie did a great job of telling us where we are and where we're going. And we think about how to get a return on our investment, a return on our decision making. But here's where we're going to turn to a more important question. What is the purpose of your money? Why did you work this hard to get here? And what's your return on life? Now, return on life doesn't improve when the stock market is up or when you update your estate plan. Rather, it's making good choices as an investor, making good choices as a planner, frees you up to live the best life possible with the money you have. So here we go. Here's our survey. All right. So it looks like relationships. Interesting. Relationships and hobbies. Not surprised that work life hasn't been great. That's been definitely a challenge. I mean, leaning out of a social environment. But it's interesting that as much as we've been separated, wow, people put in the work on relationships. Good for you. Fantastic. All right. So I'm going to talk a little bit about, I'm going to borrow an idea from Craig Groeschel, one of my favorite thinkers on the topic of leadership. And Craig talks about how the best leaders are great at anticipating what is to come, not predicting necessarily, but anticipating. They ask questions like, what if? And they look at any number of scenarios that are possible in the future and say, what if this happens? And he uses the 3 Ds that we can use to anticipate: develop, discern, and disrupt. So develop. We develop situational awareness. Where are you right now? That's part of the goal for today, is helping you to figure out where are you right now relative to the world around you. What do you know? What are your blind spots? All of us don't know what we don't know. So you should be leaning on your trusted advisors to help you ask better questions, to understand what's working in your plan, but also what's not working and understanding why. The second, discern. Discern future threats and opportunities. One person's threat might be another person's opportunity. I think Katie did a great job of saying, is that there a threat of higher taxes? Are you exposed to it? Your neighbor might be in a completely different situation than you might be in. Someone in the hospitality industry with a longer work from home routine is a threat because of the impact on their profession. But, for someone who has the flexibility to work from a home closer to their grandkids or closer to a beach, that might be an opportunity. The third is disrupt. How do we replace what is with what could be? There's a dose of healthy dissatisfaction here. So there's always a challenge to create that compelling vision for your future and ask, why not create a positive disruption in my work-life balance or my living environment or my social relationships? That poll just showed us people use this opportunity, the disruption in their lives, to enhance social relationships. I think that's a really healthy development. So in order to help you anticipate more and react less, I want to introduce you to our return on life process. Return on life is different from return on investment because it changes the central question of your financial plan. For example, which one of these questions addresses what you truly value? So several years from now, what does your life have to look like in order for you to feel a sense of well-being, that you're making progress, and that you have the freedom to live the way you want? The second question, did you beat the S&P 500 by 100 basis points? Wall Street does a great job of asking question number 2. Question number 1 is the one that really matters. And that's where framing conversations in the way that we have today, we're going to talk about investing and acknowledging that, what happens in the financial markets is meaningful. Talking about financial planning, the decisions we make about taxation and estate law and retirement planning and IRAs, those things are meaningful. But it's only meaningful in the context of, does this free us up to live, to support you toward your personalized milestones? So return on investment is forever chasing. Return on life is money serving its purpose in your life. So in life-centered planning, we start with building an awareness of your relationship with money. What's been your experience with saving, spending, stocks, debt, giving, supporting children? How are you and your spouse or partner the same? How are you different? With this understanding, we start to understand your story and how you uniquely define success. So think of it in terms of blueprints and fingerprints. Blueprints, this is how your beliefs were formed in you. What was money like growing up? What was it like for your parents? What were you taught about money that stuck with you? What was the best advice that you received, or the worst? So these blueprint experiences, they shaped us in ways that we might not even be aware of. So think about the way the millennial generation has unique spending and saving habits due to coming of age during the great financial crisis. For those of you with young children and grandchildren now, it's going to be interesting to see how the economic impact of the pandemic affects their future money habits. We all have that baggage that we bring to the table, and some of it is kind of from our formative years. Then there are fingerprints. This is where we have our own agency. What decisions did you make? What decisions did I make that impacted my finances? What are your best and worst decisions? Answering that question, the most important thing money can do for me is blank. Thinking about where we made fingerprints on our own financial lives helps us to build awareness of ourselves, but it also helps the person sitting next to you, maybe your spouse. Husbands and wives don't talk about money, and we see it all the time. I even wrote a blog last year about when we were dating, my wife thought I was broke until the night we became engaged, and she finally asked questions about my financial background. Fortunately, it was a positive surprise for her that I wasn't broke, but we didn't have those conversations until we were ready to take vows. Now, I think since then, we're really open about, okay, this has been my experience with money, this has been hers, and how do we approach future decision-making, understanding the context of our relationship with money. So the next part is, how do we measure this? So we're not looking at this and saying, well, if we're not going to measure against a benchmark, we're not going to measure against our neighbor, then what do we measure? The measure of success in the return on life approach is an individual gauge of personal progress that we call it the ROL index. And that index is made up of 20 inquiries over 10 different subjects, all designed to answer on a scale of 1 to 10, are you managing your money in a way that improves your life? And if there are areas of weakness, we turn the conversation to how we can improve that aspect of life through financial means. It sounds simple, but it's really about controlling what we can control. So there's 3 different categories. The first is well-being. So you kind of saw that in our poll question. How's your health? How's your social relationships? Then we have progress. So how are you, advancing in your career? How are you advancing in your lifelong learning, or the things that you are challenging yourself to do to continue growing, even in retirement? And the third is freedom. How liberated are you to pursue your aspirations, the highest version of yourself, highest and best version of yourself, because you have the financial support to do so? So here's what it ends up looking like. For example, on a scale of 0 to 10, we determine how strongly you would agree or disagree with statements like, I get great satisfaction and meaning from the work or volunteering that I do. I've been able to fund my needs and pursue my aspirations. I'm involved in lifelong learning through reading, training, and association with others. Or I can afford to take care of the people that I want to help. So meaning, aspiration, lifelong learning, altogether amounts to the freedom that we associate with the transition from working life. It's what we want to do. Now imagine sitting with your advisor for your review, and the conversation progressed as we have today, an update on the world, planning tailored for your needs, and then a check-in about how all this is helping you live your best life. And that's really the goal, isn't it? So by the scorecard, if we look here, it ends up, in this particular case, in an example, this person's return on life score is a 58. And when we crack that open, we can see that in certain areas, work life seems to be going really well. There's a sense of really high satisfaction with where they live. Good sense of purpose, good on autonomy, but probably someone sounds a little like me, they're a little light on leisure. Maybe they're working really hard, they're at that high aggressive stage of life, they're looking forward to stepping away, but maybe we should be thinking about, what are you not building up habits because you don't have the time, or not building up habits, healthy, leisure habits because you don't feel like you have the financial resources to do so. Those are great questions to have because we don't want that person entering retirement feeling, I can't afford to, be active and leisurely because I never thought about that in the years that led up to it. So it changes the conversation to how we think. All right. So the next phase is, and this comes back to some performance decisions. We've seen several examples of where people make decisions based on performance over quality of life. So this is where the going to cash decision comes up. Is it going to add to quality of life, or is it just going to preserve capital at that stage and call it a day? It's a fair question to ask, but it can also lead to chasing market performance, seeking out guarantees, which, as Katie mentioned, are pretty expensive right now, and also picking an arbitrary retirement number. So we've talked to people who say, I need to save X amount of dollars and then I can retire. Well, it begs the question of where does that number come from? Is that number because it's going to support this particular quality of life, or is it just what you think you need to produce that amount of income? I used to see those orange numbers that people carry around in the commercials, and really want to push back on that a little bit. So we tell ourselves sometimes that these are the meaningful financial conversations, and if we do these well, then someday we'll be able to live our ideal life. But what if someday never comes? We stay on the hamster wheel, and retirees who can't shake the never enough mentality end up pinching pennies instead of enjoying their day-to-day life. This might sound familiar, the idea that if I could just time the market right or pick the right stock, then I could enjoy the good life. But just take it from someone who monitors performance for a living. That focus is wrong because I can guarantee that if you list your 10 most important values, timing the market wouldn't be one of them. Neither would getting to X amount of dollars in your brokerage account. Your list would have something to say about the quality time with your family, and it would speak about your legacy in your community. It would reflect not on what you have, but why was it all worth it? So the final piece of the return on life process ties together investing and planning in a way that builds a rhythm for each family. We build what we call your lifeline to help you prioritize the right decisions at the right times. So I'm going to show you an example of John Parker and how we can build a lifeline that helps us to frame decisions and make sure we're prioritizing the right things at the right time and not overwhelming with all the decisions that have to be made in a given time. So you should be able to see my screen now. So John Parker is 66 years old, and on his lifeline here, we can see a series of financial and personal events, all ranked in orders of low, medium, and high. So here we are in this year, and our priorities for John, we're looking at, early this year, there were significant investment losses. So let's talk about the portfolio strategy. He's reconsidering his investment philosophy because maybe he wants to start getting more conservative heading into the latter stages of his career. And he also wants to review his estate plan. So maybe he's someone who'd be sitting down with Katie to discuss, do they need a new trust strategy? Should they be gifting different assets? But as we look forward for John, we plot out all the things that we want to consider at different times. So we're thinking about him selling his business at age 70. We're also thinking about him taking Social Security at age 67. John has an elderly parent who is probably going to need some assisted living care next year. So we're going to make that a topic of conversation at his age 67. We can also plot these by year instead of by age. So all of these financial decisions, if we wrote out a list of all the things you're going to have to consider in the course of your financial lifetime, it could be overwhelming and the paralysis kicks in. What this does is it prioritizes each year. If we think about this, we stack the deck for success later on. And by the way, as each year passes, we're able to monitor our progress along the way and say, this is what we accomplished, and we can focus on this, knowing that everything else is taken care of. So the Lifeline is a great way to visualize and tie together the investment and planning decisions and make it really manageable. It's especially helpful for spouses, where one spouse might be really worried about end-of-life care, and you can point to it and say, listen, we thought that through last year. We revisit it on a schedule every 2 to 3 years, and it takes away a lot of the anxiety. Okay. All right. So coming back to just the idea of what the advisor's role is, the advisor's role is to help you keep your focus where it should be. We see us as being a little bit different from the way other advisors have structured their business. Yes, we help you with all the things related to your money, investing, planning, but we also look at your life at the center of the conversations, not the money. This means we help you clarify what's most important, what you want money to do for you, and then we develop a plan that helps you live your best possible life. So as a follow-up to today's session, we're going to share a link where you'll be able to complete the ROL index to see your score and areas where maybe you're thriving or might hope to improve your return on life. So no matter how you feel about your financial situation right now, there's an opportunity to be purposeful in your planning and investing. Let us help. Happy to have a conversation. We're going to pause now and leave some time for questions. Anything about planning, investing, we're going to kind of go back through the chat and see if there's some questions that we can answer for people.
Yeah, can I pipe in on a couple of those questions?
Sure.
Beautiful. All right. So one of the questions I just wanted to circle back on was somebody inheriting an inherited IRA. So I just did a little quick poking around. Once again, can confirm this should this come up. We have not come across this yet, but my understanding is that the reason that a spouse who inherits an inherited IRA can take distributions according to their life schedule, they're kind of carved out, is because you can take that IRA and make it your own. So it becomes your own traditional IRA as a spouse. The problem is if you start with an inherited IRA that is then inherited by a spouse, you can't do that. You can't make it a traditional IRA. So it stays within an inherited IRA. So I believe it is subject at that second time then to the 10-year rule.
Got it.
One of the other questions in here was a husband and wife, if there's an age difference and the husband either delayed his Social Security until age 70 or perhaps even predeceased prior to age 70, and his wife is quite a bit younger, still in her mid to late 50s, what is her Social Security benefit? Can she start to receive his benefit? How does that work? So a couple of things there. One, if you've already started collecting benefits, then your spouse will be eligible for that when she hits a certain age. I'll circle back to that. If you haven't started collecting benefits, so if you were delaying but you hadn't started yet, whatever you had accrued up until that point, that then becomes, as long as it's beyond your full retirement age, which for most people right now is 67, if you're still accruing beyond that, then they get that higher amount of whatever age you were when you passed. But for survivor benefits, the survivor can start collecting those Social Security benefits when they are age 60 or older. Now from age 60 until their full retirement age, let's say 67, if they collected any time prior to that full retirement age, then their benefit will be discounted. So AKA your benefit, what you're receiving, would be less. It would be discounted over time, and it brings it down to like a 25% discount starting at age 60. So they still likely will want to delay until closer to their full retirement age. Once they hit that age 67, there's no benefit to delaying further. So hopefully that brings a little bit of clarification there on those questions.
Great. Very good. So on the investment side, we had a couple questions. I think we talked a little bit about cash, and I think we have to be very nuanced in being all in or all out. Recognizing that things do feel a little bit frothy right now, but if we take away kind of the high concentrated growth areas, things aren't as built up and frothy as we might think. So I think value stocks are worth a look. Someone asked a question, we should be looking at value stocks. I think there is a case to be made for taking that value bent. You're leaving a little bit on the table so far this year, but I also think that it gives you a little bit of a cushion of safety, and there's a margin of safety there. And value stocks tend to have more cash-rich profiles, less dependent upon future spending and future growth, more dependent on kind of stable business models. The question about gold or precious metals is one that's come up a lot recently. I mean, we all know that gold's kind of been bumping up to that $2,000 mark after really a decade of not doing much at all. I think there's a place for commodities, but I wouldn't be just focused on precious metals. I mean, if you look at things like industrial metals, whether it's iron ore, or you look at lumber or other agricultural commodities, you're really seeing that whole basket starting to bounce back up, not to mention the rebound in oil prices from being negative earlier this year. I would think we want to be exposed to that whole basket of things, especially because in retirement, that's one of the things you remain exposed to. You're still paying for gas, you're still paying for food, you're still paying for all those other cost of living increases. Gold tends to be kind of the catastrophe hedge, but the basket of commodities tends to be a good inflation hedge.
Yep.
So another question was on Social Security, Katie, asking about what happens, how we think about risks to Social Security based on maybe change the payroll tax, and what do we think about Social Security longevity?
Yeah. So prior to the pandemic, I believe we were reaching that crossover point where the money coming in was, we're getting closer to that crossover point where the money coming in, isn't sufficient enough. And so they're dipping into the reserves, the Treasury reserves, to support Social Security right now. And that reserve bucket for Social Security, I believe was projected to deplete in 2032. Social Security is funded, through payroll deductions, which a lot of those deductions companies can opt to postpone their deductions or delay them. They'll still come out later, but they don't have to have those deductions done this year. And so that could accelerate, how quickly those reserves are for Social Security, how quickly those reserves are depleted. And it is something that's been, I don't know exactly what's going to happen with Social Security. It's something that has been brought up and then put aside a lot of times over and over and over again. It's something that people don't really want to touch. I think it's kind of a policy that is, in a lot of respects, kind of controversial. My personal belief is that people that are near Social Security age right now or collecting Social Security hopefully likely will not have any changes to what they can expect to receive. But at some point, perhaps there are modifications down the road that are based on, income, other resources, whatever the case may be, that may reduce future benefits for some individuals. As I mentioned before, there's some proposals out there to increase the Social Security tax for people earning more than, I think it's about $400,000. So starting to collect more money there to help build up those reserves. I know for some of our clients, we have looked at a lot of different strategies and a lot of different scenarios. So that's something that I love doing too, because we can build out scenarios to say, okay, what if we start on this track, but then your Social Security is reduced by 20% going forward? How does that impact those crossover ages? How does that impact your strategy? And how should we be thinking about it? And so we can run different scenarios to say, what if your benefit is reduced, or what happens when? But I truly don't know.
Yeah, and I think we've always talked about Social Security being more likely a death by 1,000 cuts. That it's just going to be, it's kind of like inflation, just kind of wake up one day and realize, oh my gosh, this has been happening, and slowly the benefit might erode in certain places. But yeah.
Well, we started with that as they pushed back that full retirement age. We said, now it's at 67 for most people, but that was kind of a gradual process, and it did make a difference to the discounting out there.
True. And then one other thing, just to touch base on, just to reiterate on the election side, I know it's very, very top of mind for people. And we've had conversations internally about what are there events in life where on this date everything is going to change. And there are very few of those. I think, we The one that I did think of, birth of your first child. I think that date's coming, kind of. You can kind of pin it down, and life.
And fun, I guess.
Yeah. But life and sleep schedules change up. But things like the pandemic coming this year, or the financial crisis, or September 11th. I mean, there are things or the crash of 1987. These are things that blindside us and come out of left field. And that's one of the reasons why they cause so much dramatic effect, is because there's no chance for the market to adjust. But between now and November 3rd, the market's going to be discounting, adjusting, planning for whatever the odds are that one party's in, one party's out, or whatever balance in Congress we end up getting. So the market is a discounting mechanism that digests things over time. When things move too fast, that's when we get problems. And I just don't see, kind of coming back to the point, I don't see things moving so fast in an extension of the current administration or change to a new one that it creates long-term damage to investment portfolios. But again, don't be surprised if you see volatility and see kind of those 5 to 10% corrections, which are pretty normal.
Yep.
All right. Any other questions for us? Seeing none, we greatly appreciate everyone joining us today. We've really tried to work hard on our communication. So whether it's Katie's Coffee with Katie series, where she discusses financial planning and investing from a uniquely woman's perspective, or the blogs that we write, or we've been doing weekly market commentaries video for our clients. If there's a topic that you'd like for us to weigh in on, or something that you need some personalized advice, we're here. You can check out our website at www.mortonbrownfw.com. But we wish you and your families very well as we head into this new year of Labor Day, and we look forward to catching up with all of you soon. Thanks, Katie and Cody.
Thank you, everybody.
Yeah.
Take care.
Take care.